Well, the world now has almost $13 trillion in negative yielding bonds, and Jan Loeys, JPMorgan senior advisor for long-term investment strategy, says it looks like some quicksand. He said in a recent note there's a serious probability that in the next 3 years U.S. Treasury yields are at zero, if not negative. The whole market is sitting at those levels, and he joins us now on the phone. Jan, if you take a look at that, what would lead the U.S. to zero and negative yields, and for how long could it stay?
Well, we look at Europe, we look at Japan, see how they got there. They each made, I think, policy mistakes. Japan was trying to raise taxes. Europe are telling everybody that their debt, sovereign debt, was too risky. They got them into a recession. Yields fell. And then the market no longer believed they had control over real rates. Inflation stayed pretty low. The central bank tried to keep interest rates lower and lower, more quantitative easing. I think in the process, they created a liquidity trap. They particularly weakened the financial institutions. Financial transmission doesn't work anymore. The U.S. hasn't made an economic mistake like that yet. I'm not predicting there will be one, but at some point we'll have a recession. That recession is your deflationary shock. Given how low interest rates are right now, the Fed will at least have to go to zero and do more quantitative easing, and then you have that risk. Basically, you weaken your insurers, you weaken your banks. At that point, interest rates stay low. The global savings glut that is there remains in place.
Yeah.
In Europe, Japan, 5 years easily, and it stays there. And the longer it stays there, the more you weaken the banks, and it reinforces.
Well, does it actually pick up? Bloomberg reported today that the ECB could revamp its inflation target. I mean, they go to 3%, 2.5%, 4%. I mean, what can the ECB actually do, and how does that then sort of trickle out into the Fed, into the BOJ?
I think they're out of ammunition. There's not much more they can do. They can make things worse, which is what they're really doing with negative interest rates, which have a negative impact on the consumer and on the banks. It's game over for them. It's on to fiscal policy, which in Europe is constrained to the Maastricht Treaty, and Japan is still wary of that. So I think at some point, central banks need to pass on the baton and stop doing damage.